You were pumped about taking depreciation and saving thousands of dollars. Then, next year, the IRS says, we want that money back. That's depreciation recapture, and in this video, we'll break down what it is, when the IRS gets to claw money back, and how to plan around it. I'm Jasmine DiLucci. I'm a tax attorney, CPA, and enrolled agent. My day-to-day is actually running my CPA firm and my tax law firm. But when I realized that 8 out of 10 people get tax advice from social media, and a lot of it is wrong, I decided to start putting out accurate, complete information for free. So if there's one thing you can do to help me share real tax law with more people, it's to subscribe so we can replace bad advice with the help people actually need. So let's get to it. First things first, what the F is depreciation recapture, right? The general rule with depreciation is that when you sell an asset, the IRS first recaptures the depreciation you claimed. In other words, the amount of depreciation taken is taxed as ordinary income up to the sales price. For example, if you buy a car for $50,000 and fully depreciate it, then sell it for $60,000, the first $50,000 of gain is depreciation recapture, and the extra $10,000 is taxed as capital gain. Really common question I started getting was, but Jasmine, I heard that it goes away if I hold the asset for the full IRS depreciation period, like 5 years for a vehicle. No, no, it does not, because we have 5 different types of depreciation recapture, some that can go away, some that cannot. So today we're going to go through the different types with examples, and then we'll go over how to reduce or eliminate tax on recapture. Type 1, the IRS's favorite, ordinary income 1245 recapture. Okay, this is the most common type. It applies to tangible personal property like vehicles, furniture, equipment, and machinery, basically assets that you can touch and move. Type 2, this is the rare one, 1250 recapture, and this works like 1245, but it applies to real property when accelerated depreciation was taken. And since 1986, buildings can only use straight-line depreciation, so Section 1250 recapture now only shows up on older, pre-1986 properties. Type 3, for real estate. Okay, this is a big one, unrecaptured Section 1250 gain. This is one of the most common ones that real estate owners face. When you sell a building, the portion of the gain equal to depreciation is taxed at a special 25% maximum rate instead of long-term capital gain rates, okay? But if you sell in under a year, then that gain is taxed at ordinary income rates, just like 1245 recapture, since it is a short-term capital gain. Type 4, Section 179 recapture. Okay, this happens when you expense an asset with 179, but later drop the business use below 50% during its recovery period, like 5 years for vehicles. Okay, for example, you expense a truck in year 1, then you convert it to personal use in year 3. Even though you didn't sell the asset, you're going to have recapture. And finally, type 5, okay, bonus depreciation recapture for listed property. This is like 179 recapture, but specific to listed property like vehicles. Okay, if business use drops below 50% before the recovery period ends, you recapture part of the accelerated depreciation. Listed property is basically a label for certain assets that Congress decided are prone to personal use, so they have extra protections in place to prevent abuse. So, what can you do to plan? Okay, the key to dealing with depreciation recapture is knowing when it applies, which we just covered, and planning around it. Okay, so some recapture is unavoidable, but here are strategies to minimize or defer it. First, for real estate, use a 1031 exchange or hold the property long-term. Okay, cost segregations let you speed up deductions by converting parts of real estate into personal property for tax purposes. Okay, that means you are converting property that would have been subject to a maximum 25% recapture rate into 1245 property subject to ordinary income recapture rates. So the accelerated depreciation is great up front, but it comes with a catch. Okay, when you sell, the IRS treats the portion as higher taxed 1245 recapture. Remember, the bad type of recapture that we're trying to avoid at all costs, okay? But if you plan to hold the property long term or you use a 1031 exchange, then you escape recapture since you're not triggering it by selling the real estate and you maintain the tax benefit of the cost segregation. Second, for vehicles, keep business use high to keep your deductions, right? If you purchase a vehicle, accelerate the depreciation, and then your business use drops below 50% within the recovery period, the IRS claws back a significant portion of your depreciation deductions that you took. Okay, so the best option is to make sure you keep business use over 50% for that 5-year period. Third is you want to time the sale of the assets for low-income years or years with loss offsets. Right? Sometimes recapture is unavoidable, but you can still control the timing. know that even if you have an installment sale where you don't receive all of your cash on sale, you trigger recapture in the year of sale. Okay, so if you sell in a year when other income is lower, or if you line it up with offsetting losses, you can soften the impact. And if you want more videos that explain tax planning, not marketing myths that leave you exposed in an IRS audit, subscribe for actual tax law from a tax attorney.